unemployment claims came lower, which is very good, and also the index of manufacturers almost getting to the expansion at 50, but came higher than the previous and the forecast. That it was very good news. But why the price of dollar is getting smashed? You can see we're having this big trend as soon as the year started. This is pretty much the pressure that can generate outside factors. As we know, if you've been following the media or social media, there's been a lot of issues with Trump and Elon Musk, and they're not even in the control yet. So this is reflecting in the price. Also, the retail are putting pressure. So by a technical point of view, we can consider that price when before the unemployment claims and all the data was sitting at a range, right? We had this big push in December after the rates and all the news that were showing recovery, and the news are and the data is also backing the recovery of the dollar. But why the market is again putting pressure on the dollar, creating higher highs and not breaking structures? We broke here, and after that we managed to build some liquidity, and then we push again to the upside. As you can see, we do something very simple, that is put a trend line here in the top of the liquidity that is sitting here after the rates decision. Price went straight to that point. It's not random. You can consider this as a liquidity run because we had a lot of traders trapped here, maybe even institutions or big liquidity here. And price, as you can see also, if we take this yellow box and we set it here, we're pretty much the week by week, we're pretty much touching the range. So we're back to a double top. This means also that a lot of traders try to push the price now that it's beginning of the year, so they could get at an exit. You know, this is very much a sustained trend. We don't have very big weeks like here, so big players are yet not in the market. We're pretty much moving as retail volume, or what they will call witch huntery. So price, at least by the factors or by the fundamentals, should be gold should be in pressure. At least we remain with the bearish pressure. As you can see per macro, this is the 2 hour. We haven't break structure to the upside. We had another double top here that it's pretty similar what is going on right now with a smaller cycle. We're creating a double top with huge liquidity waiting for the next move. What's the next move? Next week we have actually some interesting sauce. We will have NFP, of course, as the first one of the year, but these two are very important also because ISM and Xauusd always provide a good insight before the NFP, and we have also the unemployment claims that we're tracking that as a recovery or a sign of strength or weakness in the USA economy. So as always, try to move with the facts. So price, if continues to put pressure on the gold price, we have this liquidity sitting here. Let's move to the 4 hour. Have tons of liquidity after these 2 weeks. These are pretty much institutional weeks, so means price is really putting pressure on the gold on gold side. Maybe people are already fearing now that dollar will be strong the next year. This year and the next months. So they are trying to dump the gold contracts they have at good prices, because this is also a very high price for gold. Remember, gold is a metal and it's used in different sectors. It's not only an investment or a jewelry or something for fashion. It's something that is needed in tons of other sectors. And we are also dependent of what, here we have the indexes of what miners can do, because even though it's real and it's something that will continue here before and after humans, the limit or the amount we can extract and circulate in the surface of our we could say of our economy, it's limited. So the more we take out of the surface, the less will be out in the future to take out. So at one point price will be very tanky, but for now there's tons yet to discover and to take out of the air. So the gold price right now is not very attractive for big investors because they're looking for yields. They don't want to wait for another full cycle to get to these prices. This was very unconventional 2024 because it was mainly the pressure that the Fed and the USA economy overall had with the inflation on the unemployment and with the rates at 5.5%. There's also another issue that the Fed kind of said that the rates won't go back to 0%. That's interesting because they usually, before COVID, left the rates at that price. I already showed that in the previous video, so we don't get too extensive at this video. So pretty much the idea is we remain bearish overall in the macro. Even though we break structure in November, the price already broke again after the second. This is the second rate cut, and this is the third. So as you can see, price reacts very heavy to whatever the USA economy is doing. So for now, consider these two key points as the buy side liquidity, these two areas. Don't wait for only one price. Give the whole area as a stop loss, we could say, or as an extension for price to react. And for the downside, we have this big institutional wick. There's not two other prices you have to be interested. This in the middle is just range. Here is just range. We need to wait for a break to the upside or a break to the downside. Very, very simple. And how we can track that? Only news can move the price. Don't wait for anything else. If you're trading more than 15-minute time frames, you're not gambling the 1 second or whatever. You are following the structure of the price based in the economy and the macro. So that will be for it. Keep the charts at least marked and follow the Forex Factory calendar so you know when it will happen.